Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.
We have a great, probably next half hour of really some amazing updates that are going to be happening in the condo world. Both Freddie Mac and Fannie Mae are going to be doing some changes that, as agents, you really all need to be aware of what's going on out there. And one of the cool things about Guaranteed Rate Affinity is that we really do these kind of calls, coaching, and really insightful trainings with our loan officers around the country to make sure that they're prepared, ready to go when they talk to those borrowers that are out, looking at a PUD, a townhouse, or a condo. And we really want to make sure that those borrowers are obviously getting the most up-to-date and really crucial information on some of these changes that are going on in the marketplace. And so with us today, probably one of the best, inside information condo leaders that we have in the country, our very own Maddy Erickson, who works with us at Guaranteed Rate Affinity. One of the amazing things that Maddy does is that she literally works in conjunction, in many cases, with Freddie Mac and Fannie Mae behind the scenes at helping to understand what is going on out there and how, as a mortgage company, we can really be front and center with making sure that the borrowers have a very smooth transition to these new changes. So Maddy, it is a pleasure to have you on with us today. Thank you very much for taking your time. I know you're super busy doing lots of condos, but we have great information here to present, and I'll let you get to it.
Well, thanks, Frank, and thank you for you and your team for having me here. It's a pleasure. And second annual condo call. So I love that we're making this a thing. So today we're going to be talking about the new agency condo lending updates. So for most of us, condo rules don't change all at once. They move a little at a time, guideline here, clarification there. But that's not what is happening in 2026. And so what we're going to be walking through today is probably one of the biggest rewrites of agency condo project standards in more than a decade. And I've been doing this for 15 years, so that's a lot for me to say. It's a big, big shift. But Fannie and Freddie are issuing these updates together, and they really reach nearly every single part of our condo underwriting world, how we review a project, how reserves are getting funded, how we evaluate insurance, and which projects are really even eligible. So the headline date that you're going to see today is March 18th, 2026. Yeah, that was a couple months ago, it's actually 3 months ago to the day. And these changes have been either put into effect or they're rolling out through January of 2027. So here is where we're headed today. Here's the roadmap. We're going to be talking about where the national condo market sits right now. We're going to talk about the changes that really everybody has been talking about, and that's the end of an era, end of limited review. From there, we're going to be talking about some reserve funding, insurance, and we'll close with a recap of the critical dates of what you guys should be doing and researching when we get out of this call. So let's crack straight into it. So before we touch on a single guideline today, I really want you to see the size of the world that these rules are governing. So about 9 million condo units exist in the country today, which is the largest pool of attached housing in the country. Roughly 80 million Americans are living in some form of an HOA, whether that be a condo, co-op, or PUD, which is about 1 in 4 people nationwide. And then there is more than 370,000 community associations. And of those associations, there is about 130,000 of those being condos. So this whole call is big. This is going to have a big, big impact. But here is the number that is kind of a shell shock, especially for me. And that's 86%. So 86% of condo originations in the country are conventional loans, which means that for the vast majority of these loans, Fannie and Freddie's rules are the rules, right? So when those rules change, eligibility is going to change, lender review is going to change, and it's going to become more longer, more cumbersome. But two numbers that tell you why this matters right now is condo origination is down a little bit from 2024. It was 148 billion peak in 2021. So the market has tightened a little bit in response to a couple of things we're going to talk about next. But this means that every project that falls out of eligibility is going to hurt a little bit more than it used to. But the last one is really kind of the whole reason why we're here today. And that is 42%. 42% of condo boards are not sure whether their own community even qualifies for federally backed financing. That's almost half of the associations out there. So that uncertainty lands on our desk, lands in your guys' backyard. So these rules are being measured against, just got a lot more demanding. So on paper, the condo market looks a little bit strained. Some of this is real, but inventory is up about 80% since mid 2022 due to economic impact, due to new condo guidelines that were released around this time. Time to contract tripled from under a month to about 90 days, and so prices are slipping in some major market areas, and those exact metros are going to be exposed by the new reserve and insurance requirements. So if I stopped here, you'd say that condos are probably getting riskier. But watch what happens when we look at the default rates between single family and condo. As you see, condo loan delinquency is about 1.5% versus single family being 2.8%. So condo borrowers are paying a little bit better than detached homeowners right now. So really, this risk isn't centralized to a buyer. The risk is really shifting over to the building. So HOA financial health, reserves, critical repairs, insurance, and this is the exact rules that we're going to discuss. So one more detail to hold on to, and that's 64% of boards. So 64% of boards that have hit a financing denial said that it has hurt their home values or their sales. So ineligibility at this point isn't just a lending event. This is a market value event for everyone in that association and everyone that's in this industry. So people always ask me, why Fannie and Freddie acted at the same time. And it's because of three reasons, three forces that really pushed them to make these changes. And so we'll start with number one, and that is safety. In 2021, the condominium project known as Champlain Towers collapsed in Surfside, Florida, and it killed 98 people. But what this did is that it exposed how badly condo infrastructure is aging and how badly it was underfunded to begin with. And so in 2021, the critical repair updates that came out were the first wave of this initiative for critical repairs and condo infrastructure. This 2026 update is really going to be the second broader wave to focus on financial stability. Second is the US insurance market. So carriers have left multiple states throughout the country, and so replacement costs and coverage really got unaffordable or impossible to find. So both agencies have adjusted to what documentation they will accept without lowering actual coverage standards. And then third is access. So hundreds, if not thousands of units have been locked out by some outdated rules that nobody really have updated in years. And so the agencies have really tightened where real risk lives, and reserves. That risk really lives in reserves and financial review. And then they've opened it up to where old rules kind of created friction with no safety payoff. So the message here is that this is one lender letter, one initiative, two agencies, one message. So financial stability is really the catalyst. Financial stability is here to stay. So reviewing condo loans without looking at buildings' financial health is really a thing of the past. So I always get questions about, are Fannie and Freddie the same? Are they different? Do they have different guidelines? Well, the answer to that today is no. They're not different. If you look on the side here and you look down to the green check marks, these updates are mirrored, right? These are the same end of limited review, same 15% reserve requirement that we're going to talk about a little bit later in January of 2027, same reserve study funding methods, same investor concentration camp, and same per unit deductible. So really the differences between the two agencies at this point is mostly vocabulary. So if you take one thing from this slide is that you no longer need two playbooks. You no longer need to know which agency does what. They are mirrored for the most part. So we're going to kick it off with some insurance updates. And so what's cool about these updates is that the standard of coverage really didn't drop. In 2022 to present day, before these updates went into effect, replacement costs was kind of a struggle for us lenders. We couldn't really verify it. A lot of insurance carriers didn't want to help us obtain information to verify it. But so the agencies always were sticklers about 100% replacement costs. That still hasn't changed with this update per se. But what it did do is it added other forms of replacement costs that is going to be accepted by the agencies. And this matters enormously, especially in hard market states. We have an endorsement to some property insurance that was hard to get in some markets. This is called Inflation Guard. It was an addition, a bell and a whistle on top of property insurance. This is no longer required. These last two are my favorite updates for the insurance requirements, and that is actual cash value. Prior to this update, actual cash value was a big no-no. We could not lend in anything that had actual cash value. And that hurt a lot of condo reviews that we did throughout the country. There's some markets that are particularly affected by actual cash value in general. However, Fannie and Freddie recognized that actual cash value, it's not all that bad. And actual cash value was always covered on a component for the roof, okay? And so now Fannie and Freddie are allowing ACV coverage for roofs. And so this is really a direct answer to how insurance carriers write policies today. So either way you cut this, right? Actual cash value or not, roofs still have to be insured. So this is another flexibility layer that is really going to help out a lot of markets across the country. And then lastly, we have the per unit deductible. There's a few different kinds of deductibles that we encounter on a daily basis. One was the per unit deductible, which essentially shares deductible risk between the HOA and a unit owner. And this was very geographically restricted depending on the peril. And so now the agencies have kind of thrown us a bone, and they have now allowed a ceiling for per unit deductibles. So a unit owner can be responsible for up to $50,000 per unit starting July 1st, which is right around the corner. And there are no more geographic peril restrictions. And a unit owner is going to be able to supplement this with their individual borrower policy. So here is the reason why we are all here, I imagine, and that's the end of an era. So this is limited review. Limited review is going to have an enormous impact, and I cannot stress that enough. Limited review was never really a niche path for lenders. This is a review type that lenders across the country, not just Guaranteed Rate Affinity, have relied on for, I mean, what feels like my entire career. But it was nearly the default for most lenders. So nearly 8 in 10 conventional condo loans. Nationally, we've heard about 65% of all condo loans undergo limited review. So this change is going to touch more volume for everything, for everybody, than anything else that we're going to be covering today. So I wanted to give you guys a little bit of a comparison. So you're going to see 5 rows here on the slide. It's the same story, essentially on every single one, what used to be and what is now going to be the norm as of August 3rd of 2026. But the two that really matter the most here is the reserve requirement, which nobody was required to calculate on limited review, and the entire financial picture of an association, which, you know, we usually took the HOA's word for it on a condo questionnaire or a letter of explanation. So we're now going to be getting more financial documentation from an HOA to get verified by us for financial stability. So the bottom line really here is, for the first time, every conventional loan beyond the exempt and waiver of project review type is going to be examining a building's financial stability. So in addition to removing limited review, I really wanted to bring in our own numbers so you guys could see, you know, this is not just an industry average. I wanted to show you how this is going to impact us. But as you see, in 2025, we completed almost 3,000 reviews, and almost 80% of that volume ran through limited review. And so May of, year to date in May 2026, we have similar numbers, right? We've done almost 1,500 reviews, and 77% year to date have undergone limited review. So limited review ending for all applications on or after August 3rd is not a minor change. This is significant. It's fundamental, and this is how most lender condo volume is going to get processed, right? So there's going to be more documentation requirements that a lender is going to need to go out and get in order to determine whether or not a building is eligible. So this is real, right? This is not just for us. This is going to be for everybody. So before we talk about the actual reserve rule change, I wanted to bring in some more data for you guys. Fresh national research published this February surveyed 56 associations against national benchmarks. And what this explains is exactly why the agencies are moving towards financial stability. And that's because of this survey, 70% of HOAs are underfunded, right? This typically means that these associations are going to be unable to successfully fund and keep up with their preventative maintenance or routine maintenance capital improvement requirements, right? 1 in 3 of these associations are sitting below 50% funding levels, which this is a high risk zone for what we deal with on a daily basis called the special assessment. So this is high risk for special assessment. It's almost a certainty. Here's the one that I do want you guys to sit with because this is very, very impactful. Nearly 90% of the surveyed associations have a reserve study, and fewer than 1 in 3 are actually following it and funding it, right? These boards are deferring funding, mainly because keeping dues low today is really easier than the conversation about raising them. So the direct result is really the proof's in the pudding. 65% of these associations really have issued a special assessment recently or anticipate one soon. 62% are not confident that they're funding enough money towards reserves in order to take care of their routine maintenance, and 43% are still running reserves on normal Excel spreadsheets. They don't have a reserve study. So this gap in information isn't really a gap. It's really the choice to defer based on economic inflation impact, right? But the choice is exactly the behavior that these new rules, especially the 15% increase in reserves, are built to stop. So the agencies are really focusing and transitioning on, financial stability again, but they're treating a reserve study, which is a document we're going to talk about in a sec, um, that they're treating this as it actually going to count. The proof is going to be in your reserve study of whether you're following it or not, and whether or not you're going to be eligible. So if a reserve study is the thing that boards are going to ignore, the agencies really just made this study matter. And so here's some good news. So starting in January 4th, 2027, buildings and condo projects will have to increase their reserve funding from 10% to 15%. And this is going to have a significant financial impact because associations already struggle to fund 10% today on their budgets. We see this probably, I don't know, 1 in 10 condos that undergo full review for us have some sort of reserve funding, um, delinquency. And so with the new updates, we are going to be able to use this tool in a much better light, and that's called a reserve study, which is a financial forecasting tool that an association can use for the next 30 years to plan and save for their routine preventative capital improvements. So the good news is that if an association after January of 2027 is not funding the 15% required, or even after August 3rd, they're not funding the 10% reserve requirement. The condo can still qualify under full review if it has a credible reserve study. And so a credible reserve study, the key word is credible. And so what does that mean? What does credible mean? Well, it means it's current, it's within the last 3 years. The HOA is following the full funding method, meaning the money is going and it's going to be able to handle everything year over year and with money left over. And it's going to mean actively funded. The HOA has to be following this year after year, and professional expertise. So this has to be completed by an independent third party. So the building below the 15% requirement really isn't a hard no. It's really a question of, hey, where's your reserve study? So lenders are going to be asking for reserve studies way more frequently than they used to in the past. So with these updates, not everything is bad, right? Not everything is shell-shocked. We have some flexibility that was given to us on a review type called waiver or exempt from project review. Traditionally, this review type allows for detached condos, attached PUDs, some no cash out refi transactions, and 2 to 4 unit condo projects undergo a super duper limited review, as I call it. And it's basically a review of a HOA's master property insurance. So what this update has done, which is live right now, is it has expanded the 2 to 4 unit criteria up to 10 units, subject to the same requirements of master property insurance being in compliance. The next one is that the 50% investment / rental cap is now gone for established projects on investment units. So projects that have had higher rental concentration, higher rentals, 80%, 90%, now those projects can be reviewed without any limitation here. And then 3, for all of my Florida folks that are here today, this one is actually pretty epic for you guys. And this is the mandatory PERS review that was required for all new construction condominium projects in Florida. this is being removed. So this now opens up lender delegated review being the standard path. We can now review these without any special approval from Fannie Mae. So PERS is not going away entirely. PERS is the golden ticket of condo lending. It's project eligibility review service that's offered by Fannie Mae for lenders and for developers who want to get more sales going in a project. This is still going to be available and it for lenders and for everybody and can still be strategically useful. So what's at stake here? So why does this matter beyond the paperwork? And that's because ineligibility is expensive in more ways than one. And it's not just for one unit, it's for the whole community, right? So 64% of boards hit a denial and said it hurt their sales and it hurt their value across the entire community. 64% is the number that I want you guys to take away today. So when a building cannot get conventional financing, the buyer pool is going to shrink to cash buyers or portfolio lenders. And so those prices, right, the rates, they're not great. And so those prices are going to compress for everybody. And it's not going to just be the unit. It's going to be that market. So for us, there's going to be two exposures. Special assessments, sometimes tens of thousands per unit for underfunded buildings that are going to be scrambling to hit the 15% reserve requirement. And then, of course, to the loans that we've already closed. If a building goes non-compliant in August or in next January for limited, full review or budgets, these owners are going to be stuck. It's going to be harder to refi. It's going to be harder to sell. So really, the risk isn't only in new files; it's in the ones that we've already reviewed. And so, with full review, the lender is going to have to again certify the financial stability of the association. So the buck stops with whoever reviewed the project. So everything that we have covered today is going to affect your deals in some way or another. So these 6 moves are really going to help you guys navigate these uncharted waters of condo underwriting and condo lending with us, GRA, as your partner. So first and foremost, these are kind of like the 6 golden rules that I always encourage everybody to do, and that's to qualify the building, not just the buyer, your borrower, your client. A perfectly good buyer can lose out if a project is non-warrantable, right? So helping us vet the building before you write or accept the offer is going to go, it's going to go miles. Second, if you can help pull some HOA docs up front, budgets, reserve studies, special assessments, ask some verbal questions from the association. Hey, do you guys have any repairs going on? Hey, do you have any special assessments going on? These documents, these verbal confirmations are really going to help us in helping you assess the risk before before the condo becomes a roadblock. So getting everything in early to us is really going to save you weeks. Third is bringing us in on day one, right? Before the offer goes in, talk to us about the project. All the Guaranteed Rate Affinity loan officers have access to me and my team, and we have tools that help our loan officers save time. We can run the building through agency databases. We can run the building through our own database, and every single time we catch something early, it's a problem that we could probably solve before we get too late into the loan file. Fourth is learn what the deal killers are. Educate yourself on condos. What is the reserve requirement? What are critical repairs? What is litigation? And how do these all impact my deal? When you spot these, right, you can be a subject matter expert. You can build trust with your buyer. And then when you spot these, you can also loop us in and we'll help you. Fifth is going to be, and this is the good news, is go back to the buildings that maybe you've lost deals in, right? We now have some more flexibility with these updates. So buildings maybe you've written off, go back and maybe we can see if they're financeable again. And then the sixth is always my favorite: set expectations early. Tell your sellers, tell your buyers, what is going on. Talk to HOAs if you have contacts with HOAs. Ask them about reserve studies. Tell them about these updates. Spread the word. But setting expectations early can really build trust with the borrower, and help the deal sail through smoothly. So if you guys save one slide from today, I hope it's going to be this one. So there are 4 critical dates that are on your screen right now. So March 18th, we're already live, and this now allows us to insurance flexibility, lend in small buildings that were previously required to undergo full or limited review. We now have investor cap removal, and we are now retiring the PERS for new construction in Florida. July 1st, we're allowed to implement the 50,000 per unit deductible allowance. August 3rd is limited and streamlined review are going to retire. Full review for everything that does not qualify for waiver or exempt from project review. And so the highest reserve study funding rule is going to kick in. And then January 4th is the next massive shift, where the reserve requirement is going to move from 10 to 15%. So if you're not at 15%, you're going to want to get a reserve study. You're going to want to do its full funding method. So let me again leave you with 4 things. And so this is one idea that's going to tie all 4 things together. Now it's one rule book, right? The agencies are doing this together. Full review is going to apply for every single lender that does condo underwriting in the country. 3 is the 15% reserve requirement. It's not necessarily a wall when you have that fully funded reserve study. And then some doors have opened. So go back to those buildings that might have been previously declined by a lender. But as always, to accelerate your success with GRA, we can get to the closing table together. So Frank, thank you so much for having me. I enjoyed this.
It was great.
Yeah. So I'm here if there's any questions.
Maddy.
Yeah.
Yeah, like there's a couple of really good questions that have come up a few different times here, and it's kind of interesting. So will there be any oversight for the HOAs for timelines or turnaround to get the proper documents in for a full review? I don't know how they would do that, but that's a good one.
That is a good question. If we can copy and paste that one, I'd actually like to research that one because I'm not sure how they're gonna do that either.
Yeah, I agree. All right. Well, everybody, I really appreciate your time. I saw lots of already great pictures of everyone doing their office meetings, and I really appreciate you having us in your office. I really hope you have a great rest of your day. Have a great weekend. And Maddy, again, thank you very much. And everyone else will make sure that we're sharing the call recording and the deck with everybody that is on this call. So thanks again, everyone.
Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer, even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others. And we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.